Listen to me, and listen closely. If you have your terminal open right now, if your finger is hovering over the buy button, or, God forbid, you are reading the morning news summary thinking it will help you make money, take your hands off the keyboard. Freeze. Breathe. You are in the kill zone. Right now, while you slept, while you drank your coffee and discussed the Greenland Crisis with colleagues, your deposit has already been divided up. It was carved, packaged, and shipped off to offshore havens. You don't see it? Of course not. They are showing you a bright picture. Trump, NATO, aircraft carriers, trade wars. This is theater. This is a smokescreen. Behind the curtains, a cold, calculated, mathematically precise murder of your capital is taking place. I am not here to teach you technical analysis. I am here to show you the autopsy protocol. I have the artifact in my hands, a document that was never meant to land on your desk unfiltered. This is the Strategic Report on the Global Silver Market for January 22, 2026. Sounds boring? Official? That's the point. The most terrifying crimes in the world of finance are described in the most boring language. There are no emotions in this report, no hopes of to the moon. There is only a dry chronicle of how smart money used you as liquidity. Let me explain to you what liquidity means in hedge fund speak. It's not numbers in the order book. Liquidity is you. It is your belief that silver will rise forever. It is your fear that war will destroy logistics. It is your greed when you see a breakout of an all-time high. We, the people inside the system, call this feed. And the last 48 hours were a feast. You think the market crashed by accident? You think this is just a correction? Look at the numbers. Look reality in the eye. I have page 7, section 6.1 of this damned report right in front of me. There is a number there that would make any risk manager at Lehman Brothers in 2008 bleed from the nose. $686 million. $686.41 million. That is not turnover. That is net outflow. That is money that was pulled out of the largest fund, SLV, iShares Silver Trust, in just 2 days. Do you understand the scale? While you were reading headlines about Trump's Greenland gambit, while you were Googling where the hell Greenland is and why tariffs are being imposed over it, the whales hit the sell button. They didn't just sell, they evacuated. They went to cash, leaving you holding the bag of silver bought at $95.89 per ounce. Let's disassemble this mechanism down to the molecules. I want you to feel this process physically. Imagine a trading floor in New York or London. Silence. The hum of servers. No one is shouting like in the movies. Traders are staring at monitors. On the screens, the XAG USD chart. It is flying up, a vertical stick. The retail crowd, that's you, is panic buying metal. Why? Because you were told that a trade war would destroy supply chains. You were told that silver is a safe haven asset. You believe the fairy tale. You see the price at 94.0, then 95.90. You get FOMO, fear of missing out. You go all in. Now look at the other side of the trade. Who is selling to you? Who is supplying you with this metal at the highs? It is done by those who read this report before it was published. These are the institutions. They see the price touch $95.89, the all-time high, ATH. For them, this isn't a breakout. For them, it is a signal for liquidation. At this moment, HFT, high-frequency trading algorithms, tuned to analyze news headlines, receive a command. As soon as Trump in Davos utters the words framework agreement and no tariffs, the algorithms flip instantly, in a fraction of a second. You didn't even have time to refresh the news page, and the robots had already flooded the order book with sell orders. The risk premium that drove the price up evaporated. Smart money saw that the threat of war had passed and instantly switched to risk-on mode, buying S&P 500 stocks. And you were left with silver that started dropping like a stone. From $95.89 to $92 and then lower, smashing through $90.94s. That is a drop of 4 or 5% in a couple of hours. In the world of derivatives, where everyone is leveraged, that is death, that is margin calls, that is scorched earth. But the scariest part isn't the price drop. The scariest part is in the artifact in this document. It exposes the lie you are being fed. Look at section 1. It is written in black and white. The current market phase is characterized by an unprecedented divergence between the paper futures market and the physical metal market. Do you understand what that means? It means the price you see on the screen is fiction. It is an illusion created by speculative capital. There is no physical silver. It's a deficit. COMEX and LBMA warehouses are emptying. Industry, solar panels, electronics, defense is sucking up real metal like a vacuum cleaner. Manufacturers are willing to pay premiums just to get the goods here and now. The market is in a state of backwardation. This is when the future costs less than the present because there is panic in the present due to a shortage of goods. You would think the price should fly into space? Fundamentally, yes. But the market isn't physics. It is crowd psychology and whale manipulation. The whales used this deficit as bait. They drove the price up, knowing you would buy into the story about shortages and war. And then, when there was enough liquidity, they dumped their paper obligations on you. They sold you air at the price of gold. And they took $686 million of real money out of the market. There it is, the heist of the century. No guns, no masks, just headlines and your ignorance. Let me translate this corporate language into human for you. The report contains the phrase, investors hedged Eurozone destabilization risks, reallocating capital into hard assets. Do you know how that translates? We scared the herd to drive them into the pen. And then another phrase, profit-taking, created a cascading sell-off effect. Translation, we pulled the lever and the floor dropped out from under the crowd. They call it portfolio optimization. I call it a slaughter. You think it's over? You think because Trump said there will be no war, you can exhale? Look at the macroeconomics block. This is a time bomb that is ticking right now. Item 3.1 of the report, labor market, demonstration of resilience. 198,000 jobless claims. That is lower than the forecast. That means the US economy is overheated. The Fed sees this and thinks, great, we can keep rates high for a long time. Higher for longer. For silver, this is a death sentence in the moment. Silver pays no dividends. It pays no coupons. When the yield on risk-free US Treasuries rises to 4.26%, big capital doesn't need silver. It needs bonds. And capital flows there. It is simple yield mathematics. On one side, a metal that is falling. On the other, US sovereign debt paying a guaranteed 4% plus. What will a pension fund choose? What will an algorithm choose? The answer is obvious. And so you stand in the middle of this battlefield. On one side, Trump's geopolitical bluff that inflated the bubble. On the other, the hard hand of the Fed popping that bubble with the needle of high rates. And in the middle, you with a phone in your hand, reading Telegram channels that write, buy the dip. Buy the dip? The report says, bull attempts to buy the dip were met with active selling into strength. This means that every effort you make to average down hits a concrete slab of sales. You are being crushed. You are being ground up. Technical analysis screams danger. The RSI shows a bearish divergence. This is when the price goes up, but the momentum falls. It's like a car driving uphill, but it has run out of gas. It is still rolling by inertia, but gravity has already won. The bearish engulfing candle pattern. It is a tombstone on the chart. But the most cynical part of this report is the calmness. The analysts write, the fundamental basis of the market remains favorable for long-term growth. Of course, favorable in a year, in two. But they will kick you out now. They will take your margin now. They will force you to sell at the bottom only to buy from you cheaply later. This is a cycle. This is the wheel of samsara in which the retail investor is always reborn as a hamster. Listen carefully. $686 million doesn't move by accident. Money like that leaves a signal. A siren Wall Street hears, even if you don't. This isn't the end. It's phase one, shock and evidence. We have the body, price, the weapon, 686 centimeters outflow, and the motive, geopolitical manipulation. What you don't see yet is how the trap fully closes while you're reading this. Don't rush for the exit. Panic is how they win twice. First on your greed, then on your fear. To survive, stop thinking like a victim. Learn how the machine works from the inside. Next, we open the archives. This script ran in 2008. In 1929, only the props change. Mortgages then, Greenland now. Same logic. Miss it and you're done. We'll break down the mathematics of catastrophe. 3 crises converging at one point. Ready to look into the abyss? Stop staring at the chart. Stop hunting for a double bottom or drawing hope at $90. Close the terminal. This isn't a market, it's a crime scene. To understand how it happened, we go to the engine room. No headlines, only ruthless math. We've seen the body, we've seen the evidence, now the mechanics. This wasn't an accident, it was a convergence. 3 forces met at one moment to rip your deposit apart. Analysts call it a perfect storm. I call it an execution. The first vector is the speed of light. You think you are trading against people? Wake up. You are trading against algorithms. The second Trump uttered the words framework agreement and no military force in Davos, you hadn't even heard the translation yet. But the machines already knew. HFT, high-frequency trading, algorithms, tuned for semantic analysis of news feeds, instantly recognize the de-escalation pattern. For a robot, this is binary code. 1. War threat gone. 0. Risk premium not needed. The result? An instant dump. The disappearance of the speculative markup in fractions of a second. You sit and wait for a bounce, while the algorithm has already flipped and is selling back to you what it bought from you at the bottom a week ago. Robots do not feel hope. They simply execute the risk-off protocol for safe haven assets. The second vector is the macroeconomic vice. While you were following geopolitics, statistics stabbed you in the back. U.S. labor market data, 198,000 jobless claims. Seemingly excellent news. The economy is strong. People are working. But for your silver position, this is a death sentence. In the twisted logic of Wall Street, good news for the economy is bad news for liquidity. A strong labor market, below 200K claims, means the Fed won't cut rates. They will hold them higher for longer. Look at the yield on 10-year U.S. Treasuries. It jumped to 4.26%. This is a mathematical wall. Why would a fund hold silver, which pays no dividends and can drop 5% in an hour, if it can get a risk-free 4.26% from the U.S. government? Capital, like water, flows to where the yield is higher and the risk is lower. And right now, that water is leaking out of your glass into the debt market. The dollar index, DXY, rose to 98.80. A strong dollar means cheap silver. This is an axiom. The rise of the DXY mechanically presses down on quotes. You are not fighting the market. You are fighting the Fed. And the Fed always wins. The third vector is the technical collapse. Look at the indicators. The RSI on the daily chart showed a bearish divergence even before the crash. The price was hitting new highs, $95.89, but the strength indicator was already falling. It's like the cardiogram of a dying man. The heart is still beating, but the pulse is fading. The market was screaming at you, "I have no strength to grow." But you were blinded by greed. And here is the finale, the bearish engulfing candle pattern. This is when one black candle covers all the hopes of the previous days. It is a technical signal for capitulation. Now look back at history. You think this is a unique situation? That this time will be different? That is the most expensive phrase in the world of investing. Open the history books. 2008, 1929. The script is always the same. Smart money gets out early. Always. Look at page 7 of the report. The withdrawal of $686.41 million from the SLV fund. It wasn't retail investors selling their coins. Physicists, retail, don't have those volumes. These are the institutions. These are the very whales who have access to information seconds before you. They used the rise to $95.89 as an opportunity to exit, not to enter. They sold into the crowd's bids. The crowd, pumped up on news about the war for Greenland, held out their buckets, and the whales dumped their toxic assets into them. History repeats itself as farce. Right now, you are seeing a classic pump and dump scheme. First, an informational trigger is created, tariff threat, and the price is ramped up. Then, at the peak of liquidity, the elephants are distributed to the population. And finally, the news trigger disappears. Trump, I was joking, and the price flies into the abyss. But the scariest part isn't even that. The scariest part is the illusion of physical deficit. Have you heard of backwardation? That's when the spot price, here and now, is higher than the futures price in the future. It is an anomaly. It is a sign of a wild deficit of physical metal. Traders don't trust paper contracts. They want metal in hand, fearing exchange defaults. Sounds cool for a bull, right? No silver? To the moon? Soon? Stop. Think like a cynic. If there is no physical metal, why is the price falling? Because the price is set not by the physical market, but by the paper derivatives market. And in the paper market, speculators and algorithms rule. They don't give a damn about the shortage of bars in London. They care about liquidity and margin. And right now, the paper market says, sell. The imbalance between paper and physics has reached a critical point. And this imbalance is collapsing not through a price rise, but through the destruction of the positions of those who bet on growth. You are trapped in time. You live in a reality of scarcity, while the market lives in a reality of liquidity. These two realities have diverged, and until they converge again, you will be ground down by the millstones of volatility. The report says, investors hedged risks, reallocating capital. Did you get that? They used you as insurance. They bought when it was cheap and sold to you when you panicked. Now they are sitting in cash or in the S&P 500, which is rising, and laughing at your attempts to catch a falling knife. This is not just a correction. This is wealth redistribution, from the impatient to the patient, from the uninformed to the insiders, from those who read the news to those who create it. We have dissected the mechanics of the murder. We have seen the historical parallels. Now you know how it works, but you still don't understand why no one told you about this. Why do experts on TV continue to say, hold your positions? Why are news feeds silent about the withdrawal of 686 million? In the next part, I will show you the trap. I will explain how the information dome works, why the media are not your friends, but a tool of the market maker. We will analyze the concept of the time gap, that very interval of time when the elite already knows, but the crowd still believes. You will understand why they sell you hope exactly when you need to be selling assets. Silence. Do you hear it? That is the sound of the trap snapping shut. But you don't hear it, do you? You hear the voices of experts on Bloomberg and CNBC. You read soothing headlines. Silver takes a breather. Healthy correction before the run to $100. They tell you, hold the line. They tell you, buy the dip. Welcome to the trap. Have you ever wondered why, when a real murder happens in the market, the media is silent? Why no one screams, run, live on air? I will tell you a secret that gets you fired without severance in the city. The media is not a warning service. It is the marketing department for smart money. Their job isn't to save your deposit. Their job is to create a buyer for a seller. Right now, you are inside the most cynical mechanism of the financial market. We call it the time gap. It is the abyss between the moment the elite knows the truth and the moment it is announced on the evening news. This time, the gap was exactly 48 hours. Look at the chronology. This is the protocol of your execution. January 21st, the world is in panic. Greenland, tariffs, NATO threat. All channels are trumpeting a trade war. You buy silver because war means growth. You are the perfect soldier in the army of liquidity. At the same time, in closed offices, algorithms had already received the signal. They knew Trump in Davos would switch from anger to mercy. They knew this before he took the podium. Insider info? Maybe. Rhetoric analysis? Definitely. And while you read about the White House ultimatum, the SLV fund had already begun dumping assets. $686.41 million left the building, quietly, no noise, out the back door. Why didn't they tell you? Because if they told you sell, who would buy those volumes at $95.89? For a whale to exit, plankton must enter. You are the plankton. Your greed is their exit strategy. Look at the forecasts. This is part of the trap. This is bait. Goldman Sachs raises its gold forecast to $5,400 by the end of 2026. Citi expects silver at $100 by March. Bob Habercorn from RJO Futures is screaming about a perfect storm for growth. Beautiful numbers, right? They hypnotize. You look at $100 and think, it's $91 now, so I'm still up, I just need to wait. But ask yourself a question. When were these forecasts released? They come out exactly when the market is at its peak. This is classic distribution. A major player will never publish a bullish forecast if he wants to buy himself. He will be silent and buy in silence. But if he wants to sell, he needs the whole world to believe in $100. He needs you to cup your hands under the falling knife, believing you are catching a star. Analysts write these reports not for you. They write them to justify their portfolios to clients while the managers themselves are feverishly hitting the sell button. The document contains a terrifying phrase: retail investors perceive any correction as a buying opportunity. That is about you. You see a discount. They see an opportunity to cash out on you. You think you are buying the bottom, but you are becoming a bag holder for years to come. Let's dissect the mechanics of distraction. The magician shows you his left hand so you don't look at his right. The left hand is the Greenland Crisis, a flashy, noisy story. Politics, maps, threats, a show for the crowd. The right hand no one sees. And in the right hand is the real cause of the crash. Macroeconomics. Boring numbers you scrolled past. US GDP is expected at 5.4%. Unemployment is low, bond yields are rising. What does this mean? It means the dollar will be expensive. And an expensive dollar is death for commodities. While you watched Trump, Powell crushed you. They distracted you with Greenland. You looked away. That's focus management, and it worked. You expected geopolitics, got economic strangulation. Your position is red. 5%, 10%. You hope. Physical deficit. China is buying. True, but irrelevant. Markets don't trade truth. They trade capital flows. And the flow has reversed. Smart money rotated into S&P 500 and NASDAQ. They sold silver strength and bought stocks. You're left holding a falling asset and a $100 dream sold by banks. That cold you feel? It's realization. No one is coming. No refunds. Tomorrow there'll be a new distraction. You're just retail liquidity. You still have a chance, small and closing. The trap is shut, but you can rip your leg free. It will hurt. Cut deep or bleed out slowly. Most will invest long-term and turn into zombies. Don't. Next comes the action protocol. No stories, only commands. What to do, where to look, when to act. It will hurt, but it's reality. Are you ready to take responsibility or wait for zero? Stop shaking. Emotions are over. Cold surgery begins. If you're still praying for a reversal, you're already half dead. Markets don't hear prayers, only orders. 3 steps, 3 hard actions. Professionals act, gamblers hope. Kill the gambler now. Step 1. Surgical amputation. Level 90.0. Look at the chart. Find the number 90 euro. This isn't just a round number. This is your last line of defense. The report says holding this zone is critical to maintaining the bullish scenario. But look truth in the eye. The RSI has already shown a bearish divergence. The impulse is dead. If the price breaks 90 zircwalers downward and consolidates there for even an hour, cut. Don't think. Don't regret. Don't wait for a bounce. Breaking 90 zircwalers opens the floodgates to hell. The next stop is the $84 zircwaler, 85 zircwaler zone. That is another 6-7% drop. Can your deposit withstand that? If you are sitting with leverage, you will be carried out feet first. Forget the entry price. Forget how much you lost on paper. The market doesn't know your average price. It doesn't give a damn. All that matters is what is happening now. And right now, the bearish scenario has a 25% probability and is rising with every minute the dollar strengthens. There will be no amnesty. If $90 falls, evacuate to cash. Better to lose a finger than a hand. Step 2. Don't catch knives, waiting zone. Are your hands itching to buy the dip? But it's cheap. It was just 96. Slap your own hands. This is a mental trap. Silver isn't cheap right now. It is falling. Your task is to become a sniper. A sniper doesn't shoot into the air. He waits for the perfect target. Your target is 84 $85 $85. That is where the 20-day and 50-day moving averages, EMA, pass. That is where smart money will re-enter, closing the gaps. The report says in black and white, correction target, zone 84 $85. This will be viewed by long-term investors as an excellent entry opportunity. Don't be the hero buying at $91 only to see $85. Be the cynic waiting for the corpses at the bottom of the river to take their gold. Until the price touches the moving averages, sit on your hands. Cash is also a position, and right now it is the most profitable position. Step 3. Follow the flow, rotation. Where did the 686 million go? It didn't vanish. It changed its address. Look at item 2.2 of the report. Investors began reallocating liquidity from defensive assets back into equity markets. The S&P 500 and NASDAQ indices are rising. Why? Because the U.S. economy is charging like a tank. Q4 GDP is expected at plus 5.4%. Unemployment is below 200K. This isn't a crisis. This is a boom. Why do you need silver, which protects against a crisis if there is no crisis? Trump canceled the war. The economy is growing. Smart money is playing risk on. They are buying tech stocks. They are buying growth. Stop thinking in categories of silver or nothing. Look where the river is flowing. The river is flowing into stocks and the dollar. The dollar is strengthening. The DXY index is rising. Don't swim against the current with a bag of silver on your shoulders. You will drown. Finale. Countdown. You have a matter of hours before the next session opens and the algorithms continue to devour the remaining liquidity. You have received the artifact. You know what 99% of the crowd in Telegram chats does not know. You know that $686.41 million has already exited. You know that the tariff threat is a bluff that has already been played out. You know that fundamentally, silver is weak in the face of high Fed rates. Right now, you have a choice. Option A, close this text, open your terminal, see the negative balance, and tell yourself, I am an investor, I will wait it out. This is the victim's path. This is the path of the person who pays for hedge fund banquets. Option B, admit the mistake. Realize the loss if the $90 level is broken. Save the remains of your capital, and wait for the moment when the blood on the streets dries. Remember, the market is a mechanism for transferring money from those who think tomorrow to those who know now. The insiders have dropped the ballast. The train has left light. If you are left on the platform with heavy bags, it is not the market's fault. It is your choice. Act or become history. End of transmission.